I was advised to take a look at Splunk because I wanted to know what it was. Obviously, you see the name and you're like, what the freaking heck is Splunk? I had no clue, alright? This is a company I'd never heard of until actually just not too long ago. So I'm going to take a look at these earnings results that they posted here. You see they started off down pretty big as the market closed. They got hit hard. And then they reversed that down around 4%. Then they reversed it to finish up around 4% after hours. So they completely reversed what they had originally. It was pretty wild. So let's look at these results, and I want to find out what this company's about. Yeah, very excited. Well, Splunk post a quarter one non-GAAP EPS of negative 56 cents, beat by 1 cent, and a GAAP EPS of negative $1.94, missed by 31 cents. Oh my gosh. Oh my gosh. That's okay. Revenue of 434 million, plus 2% year over year. Only what? Missed by 9 million on that aspect. That is not that big of a growth number to justify a negative $1.94 EPS line. Sorry, these are my initial reactions to this company. So you'll have to give me a second to look through. You get inside the mind of me when I'm looking at a new company. That is just an ugly line. I will say that. Trading at a market cap of 26, take that into account. When you see annualized revenue, we'll take a look at that. Probably somewhere around the $1.5 billion range. So it's a little maybe overvalued. Let's take a look at it though. So maintenance and services revenue grew 8.5%. Cloud services grew 80.7%. That is where your valuation comes from, children. Alrighty. It's all with the cloud. And that's massive growth there, 80% on that aspect. But it's not the biggest portion of their business. It's actually the smallest portion of their business. And the license segment decreased 26.9%. Ooh, funny. Net loss of $305 million. I don't like that. Is that just me? That they only brought in a revenue of $430 million, but lost $300 million for net loss? That's not a good number. But we'll look at the history. Hopefully the slides they presented give me a little history so I can actually tell for sure what matters here. They did give guidance. Believe it or not, they gave guidance. So revenue of approximately $520 million. That would be good growth. It looks like quarter over quarter at least. And a non-GAAP operating margin of negative 15 to negative 10%. Okay, don't like that in terms of margin. You don't like to see that negative margin, but we'll see. So obviously one thing they talk about here is recurring revenue. Total recurring revenue here right now has been increasing quite a bit, actually, is what it looks like. So that's not a bad number. 1.7 billion right now in recurring revenue. And you see from these charts, there is growth, and this is over a full year's worth of quarters. So definitely nice growth there. I will give it credit. And even on the cloud segment, you see continuous little growth there. Definitely not bad. Not bad, all things considered. Their transition to a subscription model. So quarterly cloud percentage of total software, that's been increasing. Interesting. Cloud has taken over, obviously, for this company, and that's probably the key point. That's probably why, if you look at a brief history of the stock, which there isn't much of a brief history, there's kind of a brief history. It's not like it's skyrocketed by any means. Yeah, it'd be hard to say that this thing has skyrocketed, right? We say since 2016 up 400%. Nothing too crazy. It is up pretty high, but let's get back to these slides. Let's see. Remaining performance obligations in terms of dollar amount, which is obviously revenue that's coming to them. Pretty nice there. You see a growth story there. More money headed their way. Revenue plus change in remaining performance obligations, which is just a combination there. Nothing crazy to note really from that in my perspective. These are some boring slides, is what I can tell you. But cloud revenue, look at that. Average contract duration in terms of months looks like there's not much you can really tell from it, but it looks like you've had a decline in the last quarter. But overall, there's some pretty good growth there in terms of average contract duration. Now, how you take that depends on you. Longer service, more money for them, right? It really just depends on the value of the contract, most honestly. As far as revenue by geography, 65% right now is U.S. based and 35% international. It's been relatively around those numbers consistently. You don't see anything crazy with cloud either, so nothing really to poke at here. Besides, maybe international is getting a larger portion of that revenue now. So one thing to consider maybe. So number of orders over $1 million. You see this quarter they had 81, which is pretty good growth compared to the year prior, in which they did 46. And again, this is going to be a quarterly phenomenon here. One of these things where you see throughout the year they just grow more busy. It's just kind of how it is. Quarter one's the slow quarter for them, is what I can tell. But if you look at it as far as from the year standpoint, you see on the right side of your screen that chart there just is nice because it shows you from a year standpoint there is nice growth in terms of those large orders. Gross margins, though, I mean, you did see a rise. Then this past quarter seems to be not a beautiful one in terms of that. So average recurring revenue, they're showing me a expected 40% annual growth rate, which would be massive if that was the case. Not 2% as we saw, but that would be massive. And as far as expectations are concerned, they're expecting profitability in 2022. So, you know, I get it. There's not, in my portfolio specifically, I typically only try to hold a couple companies that are not profitable that give the estimate of profitability. And I'm not saying this company can't do it, but the margins right now certainly don't provide that they can. I'd like to see a better, written out, detailed plan as far as why 2022 they plan on seeing this positive number here. It'd be interesting to look at, but not sure. I mean, nothing too crazy as far as that's concerned. I mean, it's fun to learn about the numbers that this company offers. Obviously, I've taken a look at just what they offer, but as far as the numbers, this is an interesting one to look at. Now, the balance sheet, I gotta look at the balance sheet. I always do. It's just the goal. This is how you really truly value a company. They're giving me a quarter-over-quarter comparison. Let's look at the total assets of $5.2 billion versus a $5.4 billion last quarter. So shrank down a little bit in terms of total assets, but from a liabilities perspective, total current liabilities of 1.1 versus 1.3. So they shrank the current liabilities a little bit, and they shrank the current assets a little bit. Nothing crazy. Total liabilities has stayed relatively constant around 3.4 billion. That does equate to overall stockholder equity of 1.8 billion. So there is a good thing to note on that aspect. When you talk about the burn rate on that, I mean, net loss was 300 million, I should say. They did post a positive-ish cash flow this quarter. I mean, it's debatable how they want to say that, but it's a non-GAAP perspective. But net loss is what I'm really going to focus on here. $300 million. They definitely have the cash to survive quite a while, especially that 2-year period. I think they should have the ability to survive that time and earn this profitability regardless. I think from just looking at this company as a company that will attract it'll attract outside attention regardless, and if they needed money, I guarantee you they could raise money. So I don't think bankruptcy is obviously not a near concern for this company. My only concern with the company is valuation, and where do you get the value from? If it's a company that doesn't have a forward PE ratio and doesn't have a current PE ratio, it's hard to value necessarily. The only thing I tend to look at would be the market cap on it. Market cap of $26 billion for a stock with annualized revenue of 1.5 to 1.7 billion is not necessarily the most fair valuation, but there's a lot more stretched valuations out there. It's entirely based off what you think this company deserves to be at. Is it going to shoot up that much more in the next 2 years, or are investors going to wait until we actually get some better signs of profitability first? That one, I don't know. I'd like to look more into this company, but obviously it's not one that I think at these values is a buy. Just based off the looks of it, I don't think this is currently something to be considered a buy. I'll have to think about a buy price, but not one that I'm super excited about at these levels for sure. And if you are, I could understand why. Just based off the company, if you're looking from a long-term perspective, I think this could be a good long-term hold. If we're talking about, the future, this is a company that's pretty future-proof as far as that's concerned. So, yep, I think that's all I got for you. So I hope you enjoyed.